The recent $36 billion sell-off of U.S. Treasury bonds by countries like Canada, China, Singapore, and others wasn't just a routine market move, it was a loud, strategic signal. This coordinated pullback from U.S. debt markets reflects a broader shift in global sentiment, driven by mounting trade tensions, uncertain monetary policy, and rising geopolitical risks. While the total foreign holdings of U.S. debt still exceed $9 trillion, cracks are beginning to show. And those cracks tell a deeper story about the world's growing discomfort with America's economic direction. According to the latest Treasury International Capital (TIC) report, private foreign investors dumped nearly $47 billion in long-term U.S. bonds in a single month. Meanwhile, official institutions only added $6 billion, and short-term bond holdings dropped another $12 billion. This shift is not a random fluctuation, it's a message. The primary driver? The resurgence of former President Donald Trump's aggressive trade strategy. The first domino was trade conflict. On February 1st, the U.S. slapped severe tariffs on Canadian and Mexican imports, soon followed by a sweeping 34% tariff on Chinese goods. Rather than respond with aggressive countermeasures, several nations opted for a more subtle but potent tool, reducing exposure to U.S. debt. It was a nonverbal rebuke, a warning shot fired from their bond desks instead of their foreign ministries. Selling treasuries in this context wasn't just financial, it was political theater without words. Secondly, the Federal Reserve's inaction added fuel to the fire. Despite increasing global demand for stimulus, the Fed held rates firm between 4.25% and 4.5%, resisting pressure to cut. For international investors, this stubborn stance created volatility in bond yields. Higher rates devalue existing long-term bonds, making them unattractive. With no clear roadmap for monetary easing, investors began questioning the wisdom of clinging to U.S. debt amid fiscal uncertainty. Thirdly, geopolitical risk is surging. Nations are increasingly concerned about the weaponization of the dollar, particularly via sanctions and asset freezes. For countries like China and strategic investors across Asia, maintaining large reserves in dollar-denominated assets is beginning to look like a geopolitical liability. The fear is no longer theoretical. In an age where entire sovereign assets can be frozen overnight, diversification is no longer optional, it's urgent. This sell-off wasn't confined to governments. The TIC report also shows that private foreign investors dumped $46.8 billion in long-term treasuries, while official institutions added just $6 billion. Short-term holdings dropped an additional $12 billion. The numbers point to a broad-based retreat, not a one-off policy move. In response, capital is now flowing into safer, more politically neutral financial hubs. Across Hong Kong, Singapore, Zurich, and Dubai, wealthy individuals, family offices, and sovereign funds are relocating assets. This trend is not profit-driven but protection-oriented. Recent months have seen a measurable shift. According to Monetary Authority of Singapore, MAS, data, there's been a 22% increase in portfolio flows from East Asia into Singapore's banking system as of mid-2025, largely fueled by political unease surrounding U.S.-linked assets. In Hong Kong, which still pegs its currency to the U.S. dollar, the financial implications are profound. As large-scale investors reduce their treasury exposure, it indirectly creates space for the Hong Kong Monetary Authority, HKMA, to maneuver more freely. Analysts suggest that HKMA might eventually consider broadening its peg system, perhaps incorporating a currency basket that includes the yuan or euro, giving Hong Kong more macroeconomic resilience without breaking the dollar link outright. Meanwhile, in Europe, the retreat from treasuries is also picking up steam. Leaked internal reports from large European banks like BNP Paribas, Credit Suisse, and Deutsche Bank reveal that these institutions have begun quietly offloading long-term U.S. debt, citing geopolitical exposure as a key risk factor. As political unpredictability in Washington grows, European portfolio managers are diversifying into Eurozone sovereign bonds and gold-backed instruments. What we're witnessing is not just a financial adjustment, it's a recalibration of global trust. U.S. Treasuries were long considered the world's safest investment. Today, that safe haven status is eroding. Countries are increasingly weighing the political costs of parking their reserves in Washington-controlled instruments. The global consensus is no longer unanimous, and America's financial dominance is slowly but unmistakably being questioned. Adding to this shift is the broader narrative around the dollar trap. For decades, countries accumulated U.S. reserves as a shield against volatility. But that shield is now seen by some as a leash. In a world where the U.S. can impose sanctions with unprecedented speed and scope, the over-reliance on dollar reserves has become a source of strategic vulnerability. This pressure is further magnified by Washington's recent tariffs on Chinese tech, battery components, and rare earth materials, which sparked new concerns in Asian markets. Chinese state-linked investors in Hong Kong have responded by rapidly shifting assets into alternative financial centers like Dubai, where Western influence is minimal. These moves aren't isolated. They reflect a systemic effort to untangle from U.S. financial influence. At the heart of it all lies a growing perception: America's economic might is increasingly intertwined with its foreign policy risks. Treasuries are no longer just about yield, they're about exposure, influence, and control. In sum, this $36 billion retreat is more than just a bond sell-off. It's a message, a movement, and perhaps the opening chapter in a slow-motion unwinding of dollar supremacy. While the U.S. remains a giant in global finance, its grip may be loosening, one Treasury bill at a time. The selection of new hubs for this capital relocation is far from random. Singapore stands out with its vast liquidity pools, state-of-the-art infrastructure, and geopolitical neutrality, making it a magnet for wealth. Zurich delivers unmatched legal safeguards and confidentiality, appealing to those prioritizing security. Dubai has emerged as a pivotal gateway for global capital seeking refuge from the US-China geopolitical tug-of-war. Together, these cities weave a network of alternative safe havens for Asian wealth, insulating it from rising political risks. While these shifts might appear disconnected, they're part of a larger recalibration by global investors rethinking risk in a volatile world. Offloading U.S. treasuries and redirecting funds isn't just about dodging taxes or chasing higher returns. It's a strategic move to rebalance portfolios as politics and economics grow ever more entangled. As capital flows shift simultaneously eastward and westward, all eyes are on China, the world's second-largest holder of U.S. debt, whose calculated retreat from these assets signals far-reaching consequences. In recent months, several of Europe's economic powerhouses, France, Germany, the Netherlands, Luxembourg, and Switzerland, have taken bold steps to reduce their U.S. Treasury bond holdings. This synchronized pullback reflects growing discomfort with the trajectory of U.S. economic and trade policies, highlighting the profound influence of political signals on global finance. A core issue is the widening monetary policy gap. The European Central Bank's growth-friendly, accommodative approach clashes with the U.S. Federal Reserve's high interest rates aimed at taming inflation. This divergence creates challenges for European investors, who face escalating costs when hedging against euro-dollar currency fluctuations, rendering U.S. bonds less attractive. Adding fuel to the fire are trade tensions, with Europe wary of potential U.S. tariffs targeting German automobiles or French luxury goods. By scaling back U.S. bond exposure, European nations are not only safeguarding their finances but also sending a subtle message of disapproval. This isn't a solo effort by individual countries acting in isolation. The coordinated reduction in U.S. bond holdings across multiple European capitals points to a deliberate, strategic response to shared concerns. Such moves were rare in past decades, but today they reflect a growing consensus among European nations to reduce dependence on the U.S. financial system. With the U.S. grappling with domestic political uncertainty and ballooning national debt, the long-held view of American bonds as the ultimate safe asset is losing its luster. By diversifying into euro-denominated assets and other regional instruments, European countries aim to shield their reserves from shocks tied to U.S. policy shifts while strengthening the Eurozone's financial independence and global influence. This European pivot aligns with a broader global trend. Recent International Monetary Fund data reveals a steady decline in the dollar's share of global reserves, with nations in Asia and the Middle East adopting similar diversification strategies. The $36 billion sell-off of U.S. Treasury bonds by countries like Canada, China, and Singapore underscores a profound shift in the global financial order. Far from a one-time event, this reflects a strategic response to U.S. tariffs, restrictive monetary policies, and escalating geopolitical tensions. For observers of global politics and power dynamics, this is more than a market trend. It's a form of financial diplomacy signaling widespread doubts about the dollar's unchallenged dominance. Looking ahead, two possible futures emerge. If the U.S. softens its trade stance and lowers interest rates, confidence in the dollar could stabilize, slowing the exodus from U.S. debt. However, if Washington persists with confrontational policies, nations may accelerate their shift toward the yuan, euro, or regional currency baskets, weakening America's grip on global markets and driving up its borrowing costs. This sell-off is not just a financial maneuver, it's a political statement, a warning, and a potential turning point. The coming months will be pivotal in determining the dollar's future role and how long it remains the cornerstone of global finance. Let us know in the comments. Do you think the dollar's era as the undisputed king of global finance is ending, or will Washington recalibrate before it's too late?